Okay friends, this is one of the most important topics under central excise. Important not only from examination point of view, but also otherwise. Because central value added tax, under central excise, we follow the value added taxation system. So that value added taxation system is reflected in this scheme, Cenvat credit scheme. So this Cenvat credit scheme, latest as we see, was introduced in the year 2004. Earlier, the Cenvat credit scheme was for 2002 and 2001. It was applicable only for the manufacturer, and there was a separate service tax credit scheme for service tax. Now, after 2004, in 2004, with effect from 10th September 2004, Government of India, in fact, has integrated both goods and services as far as the input tax credit is concerned. Now, this Cenvat credit scheme is applicable to manufacturing activity as well as service activity. So, it is naturally, obviously, available and applicable to both manufacturer and service provider. So, with this, you have to understand this is relevant and important not only for a manufacturer but also for the service provider. So, whatever we study under this scheme, Cenvat credit scheme, is equally applicable to service tax also wherever it is relevant and pertinent. So, when we study service tax, we do not have to study this Cenvat credit again, only we have to make a reference of this. Entire scheme of Cenvat credit we study here, and this is automatically equally applicable to service tax also. So, in the first what I do is, I discuss the overview, I discuss the scheme in general. What is in it? First 1 hour, 1.5 hours, and including definitions. So, main areas. But these definitions we will be discussing thereafter, hereafter also, in between. When we discuss something, we discuss the definitions, relevant definitions also. But among all the definitions, the definition of input, the definition of capital goods, the definition of input service, these are prime definitions, frontline definitions, these are very, very important. So, what I do now is, I will go ahead with an overview of Cenvat credit scheme. Okay? Let us look at it. What is this scheme about? Okay? This is called Cenvat credit scheme. This is a Cenvat credit scheme, basic provisions and fundamental principles of Cenvat credit. So, first statement about this Cenvat credit scheme. This is a beneficial set-off scheme. So, in the first one, in the first part, what I would like to discuss is, what about the scheme? What is the scheme about? This is a beneficial set-off scheme. So, what do you mean by beneficial set-off scheme? So, look at this. Set-off means adjustment, you know. Set-off means adjustments. What do you mean by adjustment? Suppose some tax is payable, and with that tax some other amount is set off, that is adjusted against that. So, that adjustment is called set off, you know, but it is a beneficial set off scheme. This is a set off scheme, but a beneficial set off scheme. What do you mean by beneficial? Means it is creating some benefit or advantage to somebody. So, in the next slide you will find that benefit is available to manufacturer and service providers. Means it is a set off scheme and it is beneficial, and the benefit is available to manufacturer and service providers, which means this scheme is available to manufacturers and service providers. So, what do you mean by manufacturer and service providers? Manufacturers under central excise and service providers under service tax, that is Finance Act 1994. Means the person who is manufacturing accessible goods, the person who is providing taxable services, for them this is available. So, means this benefit is available to manufacturers and service providers. So, in this first statement, what is it that we came to know? We came to know that this is a beneficial scheme and the benefit is available to manufacturer and service providers. And next, in this statement, we will try to find out, we will try to know about what is Cenvat credit. First statement is about scheme and the second statement is about the scheme, about the Cenvat credit. What do you mean by Cenvat credit? Here this statement talks about it. Duties and taxes paid on inputs, input services and capital goods constitutes Cenvat credit. Means duties and taxes paid on three elements of credit. One is input, another one is input service, another one, third one is capital goods. Input service and capital goods are the three elements of credit, and on these three elements whatever duty or tax you pay, that is called Cenvat credit. So in the second statement, what is Cenvat credit? That is what we see. So here, the second part, what is Cenvat credit, you find under Rule 3 Sub Rule 1 of Cenvat credit rules. Rule 3 Sub Rule 1 talks about this. Next one is, the Cenvat credit taken can be used as set off against the duties or taxes payable on the output or output service, which means whatever Cenvat credit you have taken on input service and capital goods, that is your credit part, just as you did in VAT, and that credit, the sum total of duties and taxes paid on inputs, input services and capital goods can be used as set off, can be used as adjustment against the duties or taxes payable on the output or output service. You see the two phrases, output or output service. What do you mean by output and output service? So output refers to manufacturer. Suppose you are a manufacturer, you have manufactured some goods, finished goods, and you are removing them, you are paying duty. So some duty is payable on the final product. But to pay the duty, look at your Cenvat credit balance. Suppose you have some Cenvat credit balance accumulated on the duties or taxes paid on inputs, input services or capital goods. That is your credit, and that credit you can set off, you can use as set off against the duty or tax payable now on your final product. Similarly, you are a service provider, so you have to pay service tax on output service. To pay that service tax on your output service, you can have access to the credit and use it as set off and take care of it. So if you are a manufacturer, it is output, on your output you are utilizing. If you are a service provider, on your output service you are utilizing against that. So this second statement must also be clear. So for this, let us look at the same thing in a different way. Look at this diagram. So duties and taxes paid on inputs, capital goods and input services. Why the language, the duties and taxes has been used? Duties are paid or payable on inputs and capital goods, excise duty. But at the same time, you are paying cess. Cess is a tax. So duty and tax. And similarly, you have paid some service tax on your input services. That is purely a tax. So Cenvat credit is the sum total of duties and taxes paid on, number 1, inputs, number 2, capital goods, number 3, input services. So this sum total can be used for output duty or output service tax. Output duty meant for manufacturer and output service refers to a service provider. Okay? The same thing, but presented in a different way. Done. And look at this. Let's have a small example. This example is about a manufacturer. You see, let us take this small example where plastic is your input, so, or say you can say raw material, and you have paid duty on raw material, raw plastic, say 50,000 rupees, and you have used some services also, that is input service, and you paid service tax, that is 14,000, and you have also procured some capital goods. What is your end product or final product? That is plastic chairs. To manufacture these plastic chairs, you are using these three elements. One is raw plastic, second one is input services, and third one is capital goods. All these three are used for the purpose of manufacturing these plastic chairs. So the plastic chairs are your end product. On these plastic chairs, duty payable. What is the amount of duty payable? That is 1,80,000. So as per transaction value, you have calculated the amount of duty, you have assessed it, on the quantity being removed, it is 1,80,000 that is payable. Now the question is, what is the Cenvat credit available here? How much is the Cenvat credit you are getting to pay this 1,80,000. You need not pay 1,80,000 again, because already you have paid some duties and taxes at the input level. What are they? Duty paid on inputs, duty paid on capital goods, and service tax paid on input services. So, the sum total of this is available as a credit, and this can be set off against the amount payable on the plastic chairs, that is 1,80,000. Still, how we use this? Duty payable. Duty payable is 1,80,000 less credit. Less credit means less Cenvat credit. So, what is the Cenvat credit available? On input 50,000 total 100%. Input service 14,000 100%. And capital goods, it is only 50%. So, under this scheme, unless you are a small scale industry, you will be getting in the first financial year, in the beginning of the financial year, 50% only, but the remaining 50% you will get in the next financial year. So, that is the reason why on capital goods we are taking only 50%, that is 40,000. So, total credit now available is 1,04,000 rupees. This is the credit available. So, this is being set off against the duty payable, that is 180. So, 180 minus 104. So, net amount of duty payable is 76,000. So, and there is a note beneath. Look at this note here. There is a note here. On capital goods, maximum of 50% is allowed in the first financial year. That is scheme under rule 4. And of course, remaining 50% you can take next year, because capital goods are normally durable. They are lasting long. So, government has introduced such a scheme where you get in 2 financial years. Not in 2 years, but in 2 financial years. For example, you bring some capital goods in the month of March, you are getting 50% of credit on duty paid. And on 1st April, you can take the remaining 50%. That was the scheme. So, in 2 financial years, you are allowed to take credit. So, here that is the reason why on capital goods we have taken only 50%. Okay. So, credit on input, input service and capital goods put together is 104, and the net duty payable is 76,000. Done. This is an example for a manufacturer who is manufacturing, say, plastic chairs. Look at another example, how a service provider utilizes the Cenvat credit, how the service provider pays service tax by utilizing the Cenvat credit. Look at this example number 2. Say, on inputs, the service provider is paying a duty of 10,000 rupees. In fact, not every service provider is required to procure inputs. For example, a chartered accountant. So, for a chartered accountant, hardly is there anything as input. There may be some capital goods, but there may not be any inputs. But for some services, maybe some materials are required. Materials may be used for service. So, in those cases, the input, the duty was paid at 10,000, on capital goods 80,000, on input services 15,000. And he is providing a service which is taxable, on which service tax payable was 1,40,000. And then how do you utilize this? 140 minus Cenvat credit, right? So, 140 minus Cenvat credit. How do you do this? Look at this. Service tax payable is 140 less Cenvat credit, on inputs 10,000, on input services 15,000, means you are getting 100%. But on capital goods, you are getting only 50%. So, obviously, the total amount of credit is 65,000 and the net tax payable is 75,000. So, gross level service tax 140 less input tax credit, that is Cenvat credit, net tax payable is 75,000. So, you understand with these 2 examples, you should be in a position to understand that a manufacturer is also taking credit on all the 3 elements of Cenvat credit, input service and capital goods, and similarly service provider is also getting, means these 2, both of them are getting credit on all the 3. Both here means in manufacturer and service provider. All the 3 means credit on all the 3. All the 3 means input service and capital goods. Both will get on all the 3. Okay. Then look at the 3rd statement. Next statement. Input service and capital goods have been defined under the Cenvat credit rules, because these are very important. What is input? What is input service and what is capital goods? That is a $1 billion question. But these underwent changes during the last 2-3 years. There were many changes in the definitions. Input service and capital goods, because it is very much necessary to define fairly what it is and what it means. So, input has been defined under rule 2K, whereas input service under rule 2L and capital goods under rule 2A. These three definitions are very, very important. You have to read number of times, and some portion of these definitions may be difficult to understand sometimes, but after service tax these definitions become somewhat easy. Okay. So, these have been defined under Cenvat credit rules. We do not have to worry, we do not have to gamble, we do not have to speculate. They have been clearly defined, mostly clearly defined. And next, manufacturer. So, manufacturer is entitled to avail, that means to take Cenvat credit, even if he uses inputs, input services and capital goods indirectly. So, what do you mean by directly or indirectly? So, manufacturer has an advantage. For manufacturer, that benefit is given, even if he uses indirectly, not directly, he is eligible. How? But the service provider is entitled to take credit only when he uses them directly for providing output service. So, for a manufacturer, credit is available on inputs, input services, capital goods, etc., even if he uses them directly or indirectly. But for a service provider, it is input service or capital goods only when he uses them directly for providing output service. Direct use and indirect use. This makes a lot of difference. So, if you read the definitions of input service and capital goods, you will find out. So, if a manufacturer is using in the factory, whether directly or indirectly, or for production or in relation to production, okay, credit is available. In the case of service provider, he should use it in connection with service he is providing, otherwise not available. Let us take a small example. A chartered accountant may be using a very good neat and clean office with what we can say carpets and all, red carpet welcome to the clients, with air conditioning, air conditioners, everything, centralized AC, red carpet, very clean and neat carpets, everything. And he is using what we can say vacuum cleaners to clean the carpets. In a chartered accountant's office, he is using vacuum cleaners. But for a chartered accountant, this vacuum cleaner is not a capital goods. This is not capital goods. He is not going to, he cannot get the Cenvat credit on these vacuum cleaners, because he is not using the vacuum cleaners directly to provide service. So, it is not cleaning service that the chartered accountant is providing to the clients. He is cleaning the floor, he is cleaning the carpet, he is not cleaning anything for the client. So, it is not available. But at the same time, a cleaning housekeeping services. So, for the person who is providing housekeeping services for cleaning malls, offices, etc. So, for cleaning malls, offices, etc., maybe in malls, etc., offices, big offices, the contractor will come with his staff and the staff will clean everything. That is called cleaning services or housekeeping services. So, for housekeeping services, maybe that cleaning man is using carpet cleaning, that is, he is using vacuum cleaner. So, this vacuum cleaner is capital goods for this housekeeping service provider, whereas the same thing is not capital goods for the chartered accountant, because chartered accountant is not using this directly to provide service, whereas the housekeeping service provider is using the vacuum cleaner directly, because vacuum cleaner is a indirect use for service. So, what is capital goods to one particular service provider may not be capital goods for another service provider, because what we are doing, that is important. And similarly, if a chartered accountant keeps, say, computers, systems, he has 4 or 5 systems and he has articled clerks. So, they are using, and he is storing the data, data entry is taking place and he is storing the data relating to his clients and using the data, and he is serving the customers by using this. So, in such a case, that computer is capital goods for the chartered accountant, but vacuum cleaner is not. In similar way, inputs, if you look at the definition, you find, suppose floor cleaning material to keep the floor hygienic, because say a manufacturer is manufacturing say food products like biscuits. The food products there should be very hygienic environment, clean and neat and clean and tidy. So he is using this manufacturer is using some, what you can say, floor cleaning material. And maybe a beauty parlor is also using housekeeping floor cleaning material. So very good floor cleaning material. Maybe both of them are using the same floor cleaning material. For a beauty parlor, the floor cleaning material is not input. For a manufacturer, the floor cleaning material is input. Why? Because for a manufacturer, if you look at the definition of input, you find used in the factory, whether used directly or indirectly, it doesn't matter. So for a manufacturer, this floor cleaning material, even though floor cleaning material is not directly participating in production activity, it's not a direct material at all. It is like a consumable. So still, manufacturer is getting credit because by definition it is input for the manufacturer, and whereas that is not input for the beauty parlor, because that beauty parlor is not using that material directly to provide service. And look at the beauty parlor's case. The same beauty parlor, suppose it is using some cosmetics to provide service, say facials, etc., etc. So that material, that cosmetic material being used by beauty parlor is an input, because the parlor is using directly for providing output service, bleaching, etc. So whatever material or input or capital goods you use directly to provide service, then it is input or capital goods for you if you are a service provider. But whereas for a manufacturer, even if he uses indirectly, not directly connected with production, still it is considered input or capital goods, etc. So this, to find out this distinction, you have to read and reread these definitions very carefully. The definition of input, by its very nature, it is use based definition. So for a manufacturer it is one treatment, and for a service provider it is another treatment. That should be very careful. That is the reason why the definition of input service and capital goods, all the three are very, very important. You have to read very carefully. The fourth statement, no credit is available. This is a very important principle. This is providing a very valuable, important principle of Cenvat credit scheme. In fact, this principle is universal. It is universally applied wherever value added taxation system is followed. More than 130 countries are following this value added taxation system. In fact, our central excise became a value added tax from the year 1986. At the time, in central excise, we introduced what is known as mod VAT scheme. So with the introduction of mod VAT scheme, our central excise has been converted into value added taxation system. Okay? But as far as sales tax is concerned, we became VAT, value added tax, under sales tax in the year 2005, 2003, 2005 onwards. But in excise it was there earlier. In services it was in 2002, and afterwards that was cancelled, that was repealed, and service tax matters have been merged with this Cenvat credit scheme. So whatever I am going to discuss, this is a universal principle. Universal means applicable uniformly in every country. Without this principle, this scheme cannot work. What is that very important principle? Left side you see, no credit is available. No credit is available on those inputs and input services whose output or output service are exempt. Services are exempt. This we study in VAT also. That is Rule 6.1. It was specified in Rule 6.1 and subject to exceptions under Rule 6.6 for a manufacturer and Rule 6.7 for a service provider providing service to SEZ units or exporting services. So, what does this signify? No credit is available on those inputs and input services whose output or output services are exempt. If you observe, if you read carefully, you will find out there is no mention about capital goods here. So, they are only talking about inputs and input services, not capital goods. Why? See, for capital goods, there is a separate treatment under Cenvat credit scheme. In many a case, there are separate treatments, but a like treatment is there in most of the cases for inputs and input services. That is the reason why. So, we are specifying emphatically the case for inputs and input services. Means, suppose you use some input and you produce something and the final product is exempt. If the final product is exempt, automatically whatever taxes or duties you paid on inputs or input services, no, sorry, you can't take credit. If you are allowed to take credit, what happens? On final product there is no duty virtually, and at input level also you are getting credit, means you are enjoying zero tax benefit. The objective of the scheme is not to ensure, not to make it available a zero tax system. It is not to be made a zero tax system. It is only to remove cascading effect. Suppose there is a tax paid on input and again you are going to pay tax on output on the gross value, there will be a multiplicity, means there would be a cascading effect, tax on tax. So, earlier we had a system that is known as tax on gross value. So, when the tax is on gross value, what happens? There is a cascading effect. So, when the tax is only on value addition, what happens? Tax will be only on value addition you made, and earlier tax you paid on inputs are there, already inputs have suffered tax and again they do not suffer. Only now the value addition will suffer tax. So, we have a value added tax, central excise is a value added tax, service tax is a value added tax. In value added tax, obviously we collect tax, government will collect tax only on value addition. Means when the final product is exempt, value addition is nil, but at input level they do not allow any credit. So, naturally that will form part of your cost of production, that you have to pass on that to the customer as a cost, you have no option. Okay. So, this rule is a very important universal rule given under Rule 6.1 and subject to exceptions under 6.6. So, here let us look at this with an example. This example is input plastic is used for manufacture of plastic pipes for irrigation. So, you are manufacturing plastic pipes for irrigation purpose and the duty paid on inputs is 50,000 rupees. So, you have used some inputs, say plastic and other inputs, and duty paid was 50,000, and tax on input services. You have also taken some services and you paid 20,000 rupees. So, total came to be 70,000 and plastic pipes for irrigation are exempt. See here. So, these you have used these inputs and input services and paid taxes also, but fortunately or unfortunately the final product is exempt here. So, when the final product is exempt, can you get the credit on this? Inputs and input services paid, that is 70,000. How much is the credit available to the manufacturer here? Who is manufacturing exempted goods? Because he is manufacturing exempted goods, no credit is available. The credit is nil. Why? Logic is very simple. What about your output? When your output is exempt, there is no question of any credit at input level. No input credit when corresponding output is exempt. This is a universal principle. It is followed everywhere, wherever and wherever the VAT scheme is followed. This is followed. No input credit when corresponding output is exempt. Got it? So, for this there are so many exceptions. Let us for example see a few exceptions for a manufacturer. under rule 66. One exception is direct exports. You are exporting goods. In case of exports, it is zero tax. No tax is payable. If at all you paid any tax, you will get the refund. That refund is of two types. One is called rebate. You paid duty and you get the amount back after export. That is called rebate scheme. That rebate is nothing but refund. This rebate scheme is governed by Rule 18 of Central Excise Rules 2002. And sale to UOU, SEZ unit or SEZ developer are supplied to merchant exporter. Not exporter, it is merchant exporter. So, supply to United Nations organizations or agencies or international agencies, etc., etc. The list is given under Rule 66. So, if you supply, if you sell to these people, you don't have to pay any excise duty, but at the same time you are eligible to take backup credit. You are eligible to take credit, and that credit you can utilize anywhere. In some cases you can get refund, in some cases you have to use only, you don't get refund. For example, in case of direct export, you are exporting directly under a bond or letter of undertaking, you are not using, so you will get refund. Sale to UOU, of course, there is no provision for refund, it is a deemed export, but you use the UK, you can use the credit anywhere. And if you do it to a SEZ unit, this is practically treated as export, so you will get refund. SEZ unit or SEZ developer, you will get refund. Supply to merchant exporter, it is a deemed export, so you don't get refund, but you are eligible to take the credit and use it elsewhere. United Nations organizations, you don't get the refund, but you can use the credit like this. And similarly, Rule 67, that is for service provider. So, if a service provider is exporting services, or if the service provider is providing service to an SEZ unit or SEZ developer, he is entitled to take credit, but at the same time he need not pay any tax, means he also enjoys zero tax. So, subject to such exceptions, the rule says when your output or output service is exempt, you are not entitled to take credit on input at input level. Okay. So, one very important universal principle we have studied. So, next look at the fifth point under Cenvat credit scheme. So, here virtually when do you get the credit? Point of taking, point of time. When can you take the credit? So, for that you see inputs and capital goods. For inputs and capital goods you will get credit when you bring them in your factory or in your premises. So, date of bringing, remember it is not date of receiving invoice, remember it is not date of payment, simply date of bringing inputs and capital goods in the premises. So, the day you bring in, you are eligible to take credit, but you cannot take in advance earlier. Suppose you have already paid and you have already received the bills, invoice, everything, but the goods are in transit. Can you take credit? No. You have to wait till the goods come in your premises. But at the same time, how much time can you take to take it? So, it's already you have brought in into your factory. So, suppose you have not taken credit. Can you postpone? So, up to what time? What is the time limit? Is there any expiry for taking credit? No. Under Cenvat credit scheme, there is no expiry date. You can take any time after you bring the inputs and capital goods in your factory or in your premises, even after 5 years, 2 years, 10 years, because there is no time limit. But at the time, this scheme should be available. So, there is no time limit for taking, you can take any time. At the same time, even for utilization, once you take or avail the credit, so you can utilize any time, either immediately or after some time, after years also. So, there is no time limit for taking credit, there is no time limit for utilizing credit. But at the same time, there are two exceptions here. Date of bringing. What are the two exceptions? Exception number 1. For a service provider, he need not bring inputs and capital goods to his premises. Instead, he may take inputs and capital goods straight away to the site, work spot, or to the place of customer. He need not bring them in his premises. Still, he is eligible to take credit. But the only thing is, he should have proper records, proper documents on the strength of which he can take credit. So, exception number 1 is service provider need not bring inputs or capital goods in his premises. Instead, he can directly take the goods to the work spot. That has been under Rule 4. Second exception is for manufacturer. For a manufacturer, he can take credit on such capital goods which are used for captive power plant. If the power plant, even if the power plant is situated outside your factory. For example, you are a factory located in Nagpur, and within the factory you did not have any facility of power plant, and outside the factory what you have done is you have created, you are making a power plant, and for that power plant you have procured some capital goods and you are using that capital equipment for the power plant. So, this power plant is meant for producing electricity which is meant for use in the factory, that is captive use. So, for use in the factory, if you keep a power plant outside the factory, and for that if you procure any capital goods, they are also eligible for credit. It is this exception, this facility is available only for the capital goods meant for power plant, captive power plant. For any other purpose, if you bring in capital goods and if you don't keep them in your premises factory, you are not eligible, only for power plant. So, this is, if you read the definition of capital goods, you find this. So, subject to these exceptions, you are eligible to take credit when you bring them in your factory or premises. That is specified in Rule 4.1 and Rule 4.2. Rule 4, Clause 1 and Clause 2. So, this is first part. Next, look at this other part. What about service tax? Credit on service tax. You can take credit on service tax when you receive, what you can say, invoice. So, credit on service tax can be taken only when service tax and service charges have been paid in case of reverse charge. There are two situations. One is payment of service tax under reverse charge, another normal payment made to the service provider. In the first case, where you are liable to pay service tax under reverse charge, obviously the date of payment of service charge and service tax is relevant for taking credit, which means suppose you are receiving services from a goods transport agency and you are a factory registered under Factories Act. So, you are a factory and you have received services from goods transport agency. Here, goods transport agency is not liable to pay service tax unless you are in a non-taxable territory like Jammu and Kashmir. So, you are not in Jammu and Kashmir, you are a factory and you have received services from a goods transport agency. Here, who is liable to pay service tax? You are liable, the factory owner is liable to pay service tax under reverse charge, whereas GTA is not liable. In such a case, when do you get the credit on this input service tax you paid? The day you make the payment towards the purchase of services, you are eligible, not before. So, date of payment is relevant. But in all other cases, because you know service tax is under accrual basis. So, because it is on accrual basis, as per Point of Taxation Rules 2011, the moment you receive invoice from the service provider, you are eligible to take credit. So, date of receiving invoice in all other cases, but in case of reverse charge, it is date of payment of service charge and service tax. This has been provided under Rule 4.7. This is Rule 4.7, right? So, in this fifth point, what is it that we are taking? What is it we are trying to understand? On inputs and capital goods, it is data bringing. On input services, It is date of receiving invoice in normal cases, but in specific case of reverse charge, it is date of payment of service tax and service charge. Cenvat credit can be taken on inputs and capital goods sent on job work also. This is a facility. This facility has been provided under Rule 4, Clause 5. Means maybe you procured some inputs or capital goods. You have sent them to the job worker for some operation, for activity, for any specific purpose. Even inputs means maybe for process. Capital goods may be for use. So here still you are eligible to take credit. So this is an aberration, or you can say this is an exception. This is a special case, you can say. So the general rule is you are eligible to take credit on inputs and capital goods when you bring them in factory and they are available in the factory. But in this case, these are not available in your factory, in your premises. These are sent to a job worker. Still you are eligible to take credit. This facility has been given under Rule 4.5. Similarly, Cenvat credit can be taken even on inputs stored outside the factory on a specific order from AC or DC. So sometimes in exceptional circumstances, maybe you are compelled to store the inputs outside the factory. Still, you may get Cenvat credit and still you may be allowed to utilize, subject to the condition that you take permission, special permission from Assistant Commissioner or Deputy Commissioner. So once you get the special permission from Assistant Commissioner or Deputy Commissioner, then you will get the eligibility and you have to use and you have to follow the conditions specified by ACDC in this connection. But remember, this is under Rule 8. This facility has been given under Rule 8, but this facility you should be very careful. Number 1, this is available for inputs only, not for capital goods. Number 2, this is available only to the manufacturer and not to service provider. So these two things you have to keep in mind. Next one is, it's a very, very important principle. This is again second universal principle under value added taxation system. When the tax is on value addition, this principle is invariably followed everywhere, not only in India, everywhere. If this principle is not followed, that value added taxation system would flop. What is this? This says 1-to-1 correlation between inputs and outputs need not be followed while utilizing Cenvat credit. While utilizing Cenvat credits, so 1-to-1 correlation between input and output. 1-to-1 correlation means the duty paid on a particular input should be used for its corresponding output only. Such a condition is not there. The credit on any input can be utilized for the duty or tax payable on any output or output service. So 1-to-1 correlation or 1-to-1 correspondence principle need not be followed. This has been provided under Rule 3.4a. This principle is inbuilt under Rule 3, Clause 4, Subclause A. If you read Rule 3, Clause 4, Subclause A, Rule 3.4a, you will find this. It's a very important principle. How? Let us look at an example. Through an example, let us try to understand, because this is a very important thing. Maybe you studied in VAT also. In VAT also this principle is followed. And before we go for an example, let us look at the exception to this. But this 1-to-1 correlation principle between input and output has to be observed or followed in case of this northeast regions, Kutch district of Gujarat, state of Sikkim, and also state of Jammu and Kashmir. These northeastern regions are supposed to be backward. Kutch district of Gujarat is said to have suffered because of earthquake. Big earthquake was there. And Sikkim again backward, and government of India has decided to develop it. And similarly Jammu and Kashmir. Jammu and Kashmir has been affected due to what you can say extremism. So these states, these places have been accorded what is known as area based exemption. Units located in these areas will get special dispensation or special favor, or you can say special exemption. And these units have been imposed. These units have to necessarily follow this one-to-one correlation principle. Why? Because they are getting some benefit, and at the same time this benefit is also given, means it would be they will take an undue advantage. This principle we study under Rule 12. When we do the Rule 12, we will come to know about this. But right now understand, normally one-to-one correlation between input and output need not be observed, but at the same time these units located in these areas enjoying area based exemption have to follow this one-to-one correlation principle. And then we have to understand now what is one-to-one correlation principle. Look at this example. What is one-to-one correlation? Look at this, left side input and right side output, right? So there are three inputs shown on the left side: plastic, iron and steel, and wooden material. These are the inputs. The duty paid on plastic is 50,000, on iron and steel it is 40,000, and on wooden material it is 35,000. So this is the duty paid on these three inputs. And at the output level, you see, from plastic you have, the output would be plastic furniture. Okay. From iron and steel the output will be steel furniture. From wooden material the output will be the wooden furniture. Means this is a furniture industry. So there are three varieties of furniture these people are making: plastic furniture, steel furniture, and wooden furniture. But if you look at this, plastic furniture there was a blank, and wooden furniture there is a blank, which means the plastic material is still lying in stock, that was not put into process. Means plastic furniture was not made. And again wooden material that was not put into process, and wooden furniture was not made. But what was made, what has been made here is iron and steel material has been used, and from that steel furniture was made, and obviously 1,30,000 is being made payable. So you have made steel furniture from iron and steel input, and now you are removing those goods, and excise duty payable is 1,30,000 on steel furniture. Suppose, let us see, be careful. Suppose one-to-one correlation principle we have to follow, then what happens? So if you have to follow one-to-one correlation principle, what is the credit, corresponding credit on steel furniture at input level, iron and steel, it is 40,000. And if you set off this 40,000 against 1,30,000, 90,000 you have to pay from your pocket, because only one-to-one correlation principle you are following. In fact, in this particular case, if it happens to be a northeastern region, if it is a unit in Jammu and Kashmir or state of Sikkim, it has to do that way only. Its liability is 1,30,000, its corresponding credit available is 40,000, use it and pay 90,000 from your pocket. But others, those who are not availing or enjoying this area based exemption, for others this is not necessary, this need not be followed. Means to pay 1,30,000, you can draw the credit from plastic 50,000, you can also draw the credit from wooden material 35,000. So entire credit you can take the whole and soul. So if you do it that way, total credit comes to be 90 plus 35, 125. So on left side you can total together, you can take this credit together as 1,25,000. So obviously your total credit is 1,25,000. And duty payable on steel furniture is 1,30,000. So simply pay 5,000 only. Means you are taking credit from plastic also, you are taking naturally from iron and steel, and also from wooden material, because you need not follow the one-to-one correlation principle. Means credit available on a particular, on any input can be utilized for any output made out of any other input. So here one-to-one correlation or correspondence we are not following. Okay. So this is what it means. One-to-one correlation principle need not be followed. So here what is happening? Total credit, you are not required to make separate records for each input. Input wise record you need not maintain, because put together total you can add up and take. Simply Cenvat credit receivable account debit, purchase account debit, Cenvat receivable account debit to supplier account or bank account. So Cenvat receivable account includes duty paid on plastic, duty paid on iron and steel, and duty paid on wooden material. So for plastic separate account, for iron and steel separate account, such a situation is not there, need not be there. So this is a great facility. If such a facility is not there, accounting would have been very complicated and this scheme would have failed. So the people who have devised this scheme know pretty well that it is not going to serve the purpose. That is the reason why it has been clearly made that one-to-one correlation need not be followed. I think you have understood this. So 130 minus 125, it is equal to 5,000 rupees. So there is no need for you to carry forward this plastic, no need to carry forward this 135,000 on wooden material. That's a great advantage. Because of this principle, the value added taxation system is very, very successful. Okay. So look at this. So can the duty paid on plastic or wooden material be used for duty payable on steel furniture? The answer is yes. Obviously yes. Why? Why it is yes? Because one-to-one correlation principle need not be followed. Between input and output, that need not be followed. So you need not maintain separate records or separate accounts for each input. That would have been very complicated, but that is not the case. It is a simplified mechanism. So you got it. Let's come to the next point. This is about refund. Whether any Cenvat credit paid on input service or capital goods, can it be refunded? Is refund possible? Is refund allowed? That is what we have to examine. It was not provided under the rules for a refund of Cenvat credit. You have paid and you have brought in inputs or capital goods, or you have procured input services. Maybe for any reason you have stopped your activity. Can you simply say that because I have stopped my activity, so let me get the amount back? It is like a fees paid to the institute. It is not refundable. Similarly, you won't get the refund. There is no provision for refund. Look at this statement. Outstanding balance of Cenvat credit, if remains unutilized, is not refundable in cash. There will not be any cash refund. It doesn't mean that there can be refund otherwise. It's not like that. It is not. The basic principle is refund is not allowed. Where do you find the provision? There is no provision. So absence of provision means absence of facility, absence of benefit. When a legal provision, when a law doesn't provide for a facility or benefit, it means it is not there. Lawmakers did not intend to provide that benefit. So it's not available. But at the same time, under Cenvat credit scheme, we see 3 exceptions. There are 3 exceptional cases in which you find the case of refund. Look at this one, northeastern regions, Kutch district of Gujarat, etc. The same story. Units enjoying area-based exemption. These units can claim cash refund of unutilized Cenvat credit. Why these units have been specifically conferred the benefit of taking refund? Because you see, what is happening with them? They have to follow one-to-one correlation principle. So by virtue of this principle, what is happening? Suppose they are manufacturing these furnitures, varieties of furniture. So you have iron and steel, and your output is steel furniture. So you have to follow one-to-one correlation principle. In the foregoing example, what would have happened? Total liability 1,30,000, but credit on iron and steel is 40,000. 130 minus 40, because you have to follow one-to-one correlation. So it becomes 90,000 payable. This is well and good. But if it is a reverse case, sometimes it may be a reverse case. For example, in exceptional cases, the duty payable on final product is less than input tax credit. Credit on inputs and input services. Then what happens? Let us take the same example to amplify this. Suppose you are manufacturing what we can say, furniture, steel furniture, but you have manufactured the furniture in such a way that it was defective. A particular batch was produced with some defects. So it was a defective product. So defectives, how do you deal? The company is very particular about its goodwill. What it say? Dump them. There are two options available. The management decided, no, we don't want to market these. If we market them, and our goodwill will be at stake. So what to do? Either you melt them, they have no metallurgical unit, they have no facility to melt. You melt them, make it iron again and recycle, reprocess. Another option is throw it away, sell it away as scrap. But for the government, this happens to be a better option. How? Instead of melting it, getting it melted, it will be very expensive. Management decided that sell it off as a scrap, waste, throw it away, but don't market this furniture because company's goodwill is at stake. So the company is selling as a scrap. On input or input services, the credit available is 40,000, and the scrap sold, the finished product, final furniture sold as a scrap. So naturally, because it has been sold as a scrap, low market value, low price, scrap, and the duty payable is also less. Suppose the duty payable is 30,000. The duty payable on final product, because of defective goods, the duty payable on final product is 30,000, but the credit available, corresponding credit available is 40,000. So the credit is more than the duty payable liability. So you use it, set off. Out of 40,000, you set off 30,000. Still 10,000 is remaining. And this 10,000 you cannot carry forward, you cannot use it for any other product. If it is other industry, other than these people, they can carry forward and use it for others. But for these people, it is not possible. Then what to do? For such situations, there was a rule, Rule 5A. Rule 5A, capital A, Rule 5A provides a relief here. These units, the excess credit or unutilized credit, if any, they can claim refund because they cannot carry forward, they are allowed to get refund. There is a procedure specified under Rule 5 capital A. By following the procedure, quarterly basis or whatever it is, they can get the refund. Okay? Refund is available to these people. This is one special case. Another case is cash refund of outstanding balance of credit is also allowed in case of exports under bond or letter of undertaking. This is another one. So under Rule 5, this is under Rule 5. Suppose you are an exporter, you are exporting goods under a bond or letter of undertaking. So this we will do. This is governed by, the procedure is governed by Rule 19 of Central Excise Rules 2002. There are two types of export promotion schemes. One scheme is rebate scheme. In rebate scheme under Rule 18 of Central Excise Rules, you pay duty and export and then get the amount back as refund. That refund is called rebate. Second scheme is you pay duty, you don't pay duty on final product. You simply export under a bond, submit a bond or letter, that is called letter of undertaking. On the basis of letter or bond, you export and complete export. Once you export successfully, you get the bond back, you get the letter back. So means on final product you are not paying duty. What about the input level credit? The credit, the Cenvat credit on input or at input level, that is remaining. For that what to do? Don't worry, because you have exported, exports are zero taxed. So whatever duties and taxes paid at input level, you are eligible to take not only credit but also you are eligible to get the refund of it. So by virtue of that refund, the tax becomes zero because you have exported. Exports are zero taxed. This is Rule 5. Of course, we do discuss them elaborately. What we are doing now is an overview of Cenvat credit scheme. Just an idea, brief idea, an overall view of Cenvat credit under this Cenvat credit scheme. And one more benefit, refund facility has been provided to service providers in the year 2012 in the name of Rule 5B. There was a Rule 5B added in the budget 2012. So what was it? Suppose a service provider is providing service to somebody where the receiver is liable to pay service tax under reverse charge. So because you are providing services to somebody under reverse charge, you are not liable to pay. But what about your Cenvat credit? What about the Cenvat credit at your input level? Maybe to provide that service, maybe you have procured some inputs, maybe you have procured some input services. Then what happens? In such a case, don't worry, be happy. How? Whatever Cenvat credit remains unutilized because you could not utilize because you are not paying service tax, you take refund from the department. That is provided under Rule 5B. Done? So, subject to these three exceptions, refund is not allowed. Refund of Cenvat credit is not allowed. But one more thing you have to remember. Under Rule 5, 5A and 5B, in all the three cases, you will not get refund of Cenvat credit on capital goods. Means you will be getting refund only on inputs and input services, not on capital goods. That you should make note of it. So this is about refund. Look at the left side. No doubt you will not get the refund, but at the same time you are allowed to transfer. So transfer is allowed. Cenvat credit can be transferred. Point number 9, left side. Cenvat credit can be transferred in case of merger, amalgamation, sale, lease or shifting of factory when the assets are physically transferred. When the assets are physically transferred means virtually you are transferring the assets and along with them you can also transfer credit. This has been given under Rule 10. This facility has been given under Rule 10. What is it and how is it? Suppose you are a company, you are now leasing it out, or you are selling it away, or you are having some merger or amalgamation, etc. A new entity is coming into picture. Then nothing to worry. Whatever assets means inputs and capital goods you have. Calculate the amount of duty and to that extent you transfer that credit to the transfer unit. The credit is automatically transferred. So another type of transfer is shifting the location. Suppose you are shifting the location, you are still the owner, there is no change in ownership, there is no change in management, only change in location. You are in one place now and you want to shift it to other place, same factory, entire thing you are shifting to other factory. So naturally, obviously, these inputs and capital goods you are taking away to other place, then what happens? There also you can carry the credit. Take the credit and carry it and use it there. So this is governed by Rule 10. And one more transfer facility has been provided recently in the year 2012. What is that facility? That facility has been provided under Rule 10A. Under Rule 10A, the manufacturer who imported the imported material or imported goods and paid import duty. Out of that import duty, we do it in the next. We will come to know that what are the duties and taxes on which Cenvat credit is available. So suppose you have imported certain materials or capital goods, you are a manufacturer, obviously you are eligible to take credit on excise duty paid. That excise duty is called additional duty of excise, additional duty of customs under section 3.1 or 3.3. That is also known as CVD. You are eligible to take credit on that. You are also eligible to take credit on special CVD, paid on imported goods. But in this case, where the manufacturer has paid special CVD on imported goods and the credit is with him, he is allowed the facility to transfer this credit to other sister units, his other units, other registered units. Suppose a manufacturer has 3 units at 3 places and he has brought in some imported material, imported goods and paid special CVD also. And this special CVD is not able to utilize. He is having surplus. On a quarterly basis, he can transfer to other units, other of his units, registered units by challan. But of course, this facility is not available to northeast regions, etc., which are enjoying area based exemption. So, this is another thing, very important thing. So, under Rule 10A, you can also transfer Cenvat credit on special CVD, but one special difference between Rule 10 and Rule 10A is, under Rule 10, you have to give away assets and also corresponding credit. Means you transfer the assets and you also transfer the credit on them. But under Rule 10A, you need not transfer the assets, you are allowed to transfer the credit to other units. Other units can use the credit and without receiving the material or capital goods, and they can also utilize. There is no transfer of assets in case of Rule 10A, and there is transfer of assets in case of Rule 10. So, we do study about them in detail afterwards. Next one, input service distributor. There is a concept, input service distributor, and maybe you came across in service tax. The input service distributor has been defined under Rule 2M of Cenvat credit scheme, and the scheme for input service distributor is available in Rule 7 of Cenvat credit rules, and he is allowed to transfer credit on service tax paid to its constituent units. Constituent units means connected units. Suppose I have 3 units. I am a head office. I pay for services. I pay service tax on various services received for my units. On pro rata basis, that is based on capital, based on turnover, on pro rata I can distribute to all my 3 units. That distribution or transfer facility has been provided under Rule 7 of Cenvat credit rules. And similarly, Rule 7A was inserted in the year 2008. There was a new Rule 7A, and as per the provisions of 7A, a service provider procuring inputs or capital goods for other units where there is no centralized registration system, he can transfer the credit along with the inputs and capital goods sent to them. That has been provided under Rule 7A. We do discuss these things in detail next. So, next point is taking and utilizing of Cenvat credit. This is a very, very important provision from practical point of view. Some practical aspect, taking and utilizing of Cenvat credit is subject to documentary proof and compliance of procedures. This is a very important thing. Finally, whether you get the credit or not, it is dependent on proper documentary proof, proper bookkeeping and recording, and proper reporting system. So, it is in 3 phases. Number 1, this is under Rule 9, taking and utilizing of credit subject to documentary proof. Number 1, so while you are bringing in inputs or capital goods, or while you are procuring input services, so you should have proper document. What do you mean by proper document? You should have an invoice, bill, or some document which evidencing the purchase or payment. Number 2, so on the strength of those documents you take credit, and also there should be an evidence that you have used these inputs and capital goods, etc., for this specific purpose, for your activity of providing service or for your activity of manufacturing goods. So, utilization records must be there, means proper bookkeeping and recording should be there. If you do not maintain proper books of accounts and your records do not reflect the transactions, means sorry. And thirdly, all the details of taking and utilizing must be reflected in your reporting system. There should be proper reporting system. What is that reporting system? Under Cenvat credit rules, Rule 9, that reporting system, of course, Rule 9A is also there. The proper reporting system here means you have to report through periodically filing returns. You have to file returns periodically. How? Suppose you are a small scale, you are a non-SSI, you are not a small scale industry, monthly, every month by 10th you have to file. Suppose you are a small scale industry, you file every quarter by 10th of every quarter, quarterly filing. So, you are a first stage or second stage dealer, quarterly again by 15th of next quarter. And similarly, service provider and rule 7A, quarterly by 15th, quarterly by 15th of next quarter. And if you are a service provider or input service distributor, so you submit half yearly by close of the month following the half year. For example, half year ending is September. By 31st October, you have to file. By the close of the month or within the close of the month following the quarter, following the half year. Similarly, the half year ending March, October to March. So you have to file by 30th April or before. So like this, three things you have to take care of. Otherwise, there is no guarantee that you will be able to get the credit. What are the three things? Number one, at procurement stage, you have proper documents, and at utilization stage, you have proper recording, bookkeeping and recording, and your transactions, the utilization, your utilization should be reflected in the books of accounts. Third one is, your reporting system should be proper. What do you mean by proper? You have to submit returns periodically. If you take care of these three things, then you will be eligible to take credit, otherwise you are not. As an auditor, you can give a qualified report. You can say, no, you are not eligible, still you have taken credit. You can point out. So for that, this rule is very, very important from the practical point of view. This rule 9 is very, very, very important. Done. And last but not least, very important, penal provisions, penalties. Rule 14 has assumed a lot of importance in recent times. Why? Because there is an amendment to Rule 14 in 2012. What is that amendment? If you take credit wrongly, by mistake or otherwise, and if you also utilize the credit by mistake or otherwise, then you are liable to pay the amount with interest, because you have taken and also utilized. Suppose you have only taken credit, means you have only booked the credit, but you have not utilized. So you need not pay any interest, because making an entry in the books of accounts is not an offense. It doesn't make you pay interest. But if you also happen to utilize, you have to pay interest. Okay? So this is a brief overview of Cenvat credit scheme under Cenvat credit rules 2004. And next to this, we have to see other basics as to what constitutes Cenvat credit, and of course how the inputs, capital goods, etc. have been defined. You have to read them very carefully. Okay? And what is the definition of exempted goods, exempted services? Again, these two are also important, very, very important, equally important. These things we have to take care of. So let us recapitulate. Let us try to get back. So can you tell me, when are you able to get the Cenvat credit? What is the timing of taking credit? What is your answer? The timing of taking Cenvat credit is date of bringing. Inputs are capital goods in the premises or factory. So can you take afterwards? Yes, you can take afterwards also, but not before. But can you tell me various exceptions or exceptional situations where you are not bringing them in the factory, still you are getting the credit? Yes. One is service provider. For a service provider, it is not incumbent, it is not necessary. He may take inputs and capital goods straight away to the premises of the customer or to the work spot, still he is eligible to take credit. And similarly, manufacturer. So for a captive power plant situated outside the factory, he can bring in capital goods and still he is eligible to take credit, provided that the power generated in the power plant is used in the factory. If it is used elsewhere, that is not available. And similarly, one-to-one correlation principle need not be followed, right? But there are exceptions. There is an exception. What is that exception? One-to-one correlation should be followed by units enjoying area based exemption in Jammu and Kashmir, northeast regions, Kutch district of Gujarat, state of Sikkim, state of Jammu and Kashmir, etc. So, that is under where these units get benefit under Rule 12. These have to follow one-to-one correlation principle. Similarly, can you get refund of credit? You have paid for inputs, input services and capital goods, no doubt. And the question is getting the case of refund. Can you get the refund? The answer is no. The general basic principle is no, you won't get the refund. There are 3 exceptional cases. Can you tell me the 3 exceptional cases in which you will still get the credit as refund, cash refund? Yes. One is northeast regions, Kutch district of Gujarat, etc. If any outstanding credit balance remaining unutilized, they can seek refund, they can get refund because they don't have the facility of carry forward. Second, when you are exporting under a bond or letter of undertaking, here also you can seek refund of input level credit that we see under Rule 5. Rule 5 is very important nowadays. Next, one more refund is available to service provider who is providing services to other service receivers who are liable to pay under reverse charge. Because you are not liable, because this service provider is not liable to pay service tax. So, whatever input level credit is remaining unutilized. But very important point, look at this. Whether Cenvat credit refund available under these 3 cases, Rule 5, 5A and 5B, is it available on all the 3 inputs, input services and capital goods? What is your answer? The answer is no. The refund is available only on inputs and input services, not on capital goods. Whatever excise duty you paid on capital goods is not available as credit refund. That excise duty paid on capital goods is not allowed to be refunded. Only duties and taxes paid on inputs and input services merit consideration for refund. And of course, there is a specific formula also given under Rule 5, and specific procedure has been given under Rule 5A for northeast regions, etc. So, subject to that. Okay. So, these things we have to keep in mind while we proceed further with this Cenvat credit scheme. And then what else should we look into? So, to make an entry in Cenvat credit scheme, we have had an overview, and what else is to be there. Now, you see, question of matching. What do you mean by matching here? We have learnt one important principle. What is that principle? One-to-one correlation between input and output need not be followed. That is read with Rule 3.4a. But what about duty versus duty? So, we have to examine what are the duties and taxes that are paid on which credit is available. For credit, what are the eligible duties and taxes? So, under the Cenvat credit scheme, we have to look for Rule 3.1. Under Rule 3.1, there is a list given under Rule 3.1, list of duties and taxes on which Cenvat credit is available. Do you say that this is an exhaustive list? No. This is not an exhaustive list on which list of duties and taxes you normally pay. There are others on which you pay additional duties or other taxes, but you are not eligible to take credit on them. Only the list given here, there are 11 duties and taxes, 11 in number. If you pay any of these 11, any one of these 11 or more of these 11, you are entitled to take credit. If you pay anything other than these 11, you are not eligible. For example, toiletry products, toilet preparations, toiletry products, additional duty of excise. Toiletry products, it is not there under Rule 3.1. So, even if you pay any tax on inputs or input services or capital goods on these toilet preparations, you are not eligible to take credit. And similarly, petroleum products. On petroleum products, there are some additional duties paid, additional duties of excise, customs, etc. Sorry, you are not eligible to take credit on them because it is not figuring here. It is not figured here. Rule 3.1 does not contain. Rule 3.1 is having only 11 types of duties and taxes. Only on those 11 types of duties and taxes, you are eligible to take credit. So, first of all, you should know what are the duties and taxes that have been listed under Rule 3.1. Only on those listed ones, you are eligible to take credit. Then, how to set off? What is the interchangeability? How they are set off against the duties and taxes payable at output level. And on output service or output of goods manufactured and removed, normally same or such goods, such duties or taxes are paid. For example, you are a manufacturer, you procure some inputs, on those inputs you pay basic duty called as Cenvat. And on finished products you remove or clear from your factory, so on that also you have to pay a Cenvat, that is basic duty. So, basic duty versus basic duty, whether basic duty credit can be used only for the basic duty payable on final product or whether this basic duty credit can be utilized for others also. That is a very important area, that you have to examine. So, if you look at the chart here, Rule 3.7b, that is utilization, matching of input duties and taxes versus output level duties and taxes. For this, on the left side, you find 11 types of duties. One is Cenvat, that is basic duty, and second one is said special excise duty paid under Schedule 2, and number 3 ADE. ADE means additional duty of excise. GSI means goods of special importance act. It is payable on additional duty on cigarettes and sugar, additional duty of excise on sugar and cigarettes. And similarly, number 4 CVD on imported goods, special CVD again on imported goods. You are eligible to take credit on this also. And fifth one is service tax. Service tax paid on input services. Whatever input services you have procured, you are eligible to take credit on input services. Okay. And sixth one is additional duty of excise, TTA. TTA means textile and textile articles. Additional duty on textile and textile articles. Additional duty. ADA, TTA. So again, seventh one, ADE, additional duty of excise on tea and tea waste. This was being paid on tea and tea waste. Nowadays it is exempt. On textile and textile articles also nowadays it is exempt, but you have to study that. Eighth one is additional duty of excise paid on health cess. That is called health cess. This is payable on tobacco products, gutka, pan masala, etc. This is also known as, very popularly known as health cess. So, ninth one is education cess, introduced in the year 2004, 2% on education cess. And this is payable on services, input services procured, output, excise duty on output, and also excise duty on inputs procured. So, it is payable on both goods and services. And similarly, SHE cess, secondary higher education cess, it is 1% introduced in the year 2007. It is used for secondary and higher education. And 11th one is National Calamity Contingent Duty. This National Calamity Contingent Duty is also known as NCCD. It is a surcharge on pan masala, tobacco products, and local crude petroleum and mobile phones. So, these are the 11 duties on which credit is available. So, this credit available with you can be utilized for various types of duties and taxes. So, which duty can be set off against which duty or tax, or whether any duty can be allowed to be set off against any other duty or tax payable at the output level, that is called the matching story. Matching of input level duty with the output level duty or tax. So, this matching principle has been provided under Rule 3.7b. So, first of all, we have to understand this matching principle. And until and unless we understand this matching principle, it is not possible to get into things. Okay. So, we have to make an entry in this, and on right side also you see there are 11 types of duties and taxes, and read them carefully, and you find the first 5 on the left side, that is duties and taxes paid on inputs, input services and capital goods. First 5 can be utilized for any duty or tax payable at the output level. You can say for these first 5, one-to-one correlation principle need not be followed, except few exceptions. What are the exceptions? Health cess, NCCD and mobile, and clean energy cess. Except these 3, you can use them to pay any duty or tax. What are these 5 on the left side? Cenvat, SED, ADE, GSI, ADE, special CVD, AED, special CVD, or ADE, GSI and CVD and special CVD, plus service tax. These 5 input level taxes can be utilized for payment of any duty or tax at the output level, except to pay health cess, NCCD and mobile and clean energy cess. And what about the remaining 6? If you look at the remaining 6 duties and taxes, for them one-to-one correlation principle need to be followed. Means ADE TTA balance can be used only for ADE TTA, not for any other thing. If it is unutilized, carry forward, but you can't use it for others. So means there is one-on-one correlation. Similarly, ADE T and T waste, it can be used only for ADE T and T waste. Similarly, health cess balance can be paid only for health cess. Next, education cess at 2% can be used only for education cess, not even for secondary higher education cess. There is no interchangeability. Similarly, secondary higher education cess can be utilized only for payment of secondary or higher education cess payable on goods or services. Goods or services clubbed together. SHE on goods and services, education cess on goods and services, they are clubbed together both ways. And similarly, NCCD balance can be used only for NCCD, whether it is on mobile or anything else, and it cannot be used for anything else. So, this is the matching principle. We have to discuss a little more elaborately, and then we have to look into the practical application of these things. So, before we make an entry into Cenvat credit scheme, we have to understand this concept very clearly. Okay? So, I repeat, what are the duties and taxes, 5 duties and taxes at the input level, which can be used for payment of any duty or tax at the output level? Means, what are the first 5 duties and taxes for which one-to-one correlation principle is not applicable? So, can you tell me? Say number 1 is Cenvat, number 2 special excise duty, number 3 ADE GSI, number 4 CVD and special CVD, and number 5 service tax. So, these have universal application. So, they can be used for payment of duty or tax on any output or output service. But there are 3 exceptional cases for which these cannot be used. What are the 3? Number 1, to pay health cess. You cannot pay health cess from any of these 5. Only health cess balance, credit balance can be utilized, otherwise no. Number 2, this NCCD on mobile. So, if you have to pay NCCD on mobile, nothing can be used out of them, only NCCD balance can be used. Okay, second one. Third one is clean energy cess. To pay clean energy cess, you cannot utilize any of the 5, but you have to pay in cash only, because there would be no corresponding credit. There should not be any corresponding credit. What is this clean energy cess? There is a story behind it. So, Mr. Jairam Ramesh, the then environment minister of Congress party. So, at the time when he was environment minister, he imposed some specific cess, special cess on producers of coal, coke and peat. Coal, coke and peat, PEAT peat. Coal, coke and peat are the 3 varieties on which he imposed 100 rupees per ton as environment's clean energy cess. but after that he reduced it to 50 rupees. This is called clean energy cess. How and why this is called clean energy cess? Because the producers of coal, coke and peat, what these people are doing, they are polluting environment in a big way. So there is a environment pollution. So because they are causing environment pollution, they are made to pay something to contribute to the nation. So in terms of 50 rupees per ton, and this amount will go to Environment Ministry. This amount will not go to Ministry of Finance, because cess is specific to specific purpose. Cess is collected for specific purpose and utilized for specific purpose. So this cess will go to Environment Ministry and they use it for cleaning up of environment. So because of that reason, Finance Ministry so specified that this clean energy cess amount we are not getting, and this amount is going to Environment Ministry. So don't use our credit balance. You can't use any Cenvat credit balance to pay clean energy cess. This clean energy cess should always be paid in cash only. So the producers of coal, coke and peat, they have to pay in cash at 50 rupees per ton of their production, and that amount is collected no doubt by excise department, central excise department, but the amount will be remitted. It will be sent and paid to Environment Ministry, and the Environment Ministry will use it and utilize this for cleaning up of environment. So this is the story. Okay. So except these three you can use. But what about 6? The other 6 taxes and duties, they cannot be used for anything else, only for their corresponding duties and taxes. For example, you have health cess balance. You can use it only for health cess. If no health cess is payable at the output level, simply you carry it forward, carry forward. Okay? Done.